My name is Matthew Copley, and today we're going to do a market update. We're going to talk about some of the economic indicators we're watching. We're going to talk about some of the returns that we've seen so far this year in the market and some of the opportunities with some of the investments that are available today. So the big thing that everyone is watching right now is Nvidia earnings. We're recording this on November the 18th. Tomorrow is the big day. That is when Nvidia is going to announce earnings. If the earnings come in good and the forward guidance comes in good, then we may see a big jump in the markets. If it's a disappointment, then you will potentially see a big downturn in the markets. The reason this is such a big deal is Nvidia is a massive, massive part of the stock market now. That one company now makes up 8% of the entire S&P 500. So it can really move the markets. Now, everyone's talking about Nvidia, and they're talking about Oracle, and they're talking about all these tech companies. But really what I'm watching is the private credit markets collapsing. This is a real potential problem. Companies like Blue Owl and Capital One, you're seeing a lot of blowups. We saw this with some of the banks, some of the regional banks. We're seeing this in some of the auto lending and used car markets. There's some real problems. Companies like CarMax, really big drops in stock price, real concerns regarding what earnings look like. And so looking at those kind of economics, we are seeing some potential risk. Obviously, there's a lot of excitement around AI, around the data centers. So a lot of money pouring in, a lot of spending on artificial intelligence. This is something that is a huge potential, and I really think artificial intelligence is going to make some big inroads in the economy. We're going to see some real positive things from this technology in efficiency and helping people and helping companies grow earnings. However, there's one big challenge that we're running into with all these data centers, and that is energy. There's just not enough energy to power what we need. We are looking at energy needs of like triple what the current energy needs are, say over the next 10 years. Just between now and 2028, they're talking about the equivalent of like 40 new nuclear power plants needed in order to just hit the energy needs that they need. So with those kind of numbers, I think that energy is going to be the big problem. And I do not think they're going to let everyone's electricity bill just double or triple because of all this AI demand. I think you're going to see a lot more infrastructure that's going to be put in energy, including natural gas power plants, nuclear power plants. And so energy is something that we are watching very closely. I think there's an opportunity, and that's why we're invested specifically a certain way in some energy type investments. Right now, oil and gas prices are pretty low, and I think there's a real opportunity there because of the high demand that we're going to see from these data centers going forward. One area we're of course watching is gold. We have a lot of our clients invested heavily in gold investments. It's driven a lot of the outperformance this year for a lot of our clients. And as I mentioned in the last video, I thought gold would probably pull back. Potentially to the 21-day moving average, maybe to the 50-day moving average. It did pull back exactly where we thought it would in the 21-day moving average, right at that point. And the thought was if it broke that, it could break down all the way to maybe 36.75, but it did not break. It held that level, and now we are trading up again. Gold is back above 4,100 an ounce. So it looks like this may be it. Gold may continue to rise from here, potentially hitting a new all-time high. That could happen as early as the end of the year, but I do see gold at $5,000 an ounce or above sometime in 2026. That's why we are not trimming any of our positions. We have trimmed just a little bit inside the tactical fund just to rebalance, just because we've had such a big gain in that position. But for the most part, across the board, we are maintaining those high levels of gold, which I think is really a smart move, considering that all the demand for gold is among institutions, the central banks. I don't think China or India or Russia or Turkey or any of these countries that are buying gold are going to sell their gold. That's not going to happen. And the only potential is that we're going to have the retail public wake up and start buying even more, which will drive up the prices because it is severely underowned at this point. Less than 0.5% of people's investments now in the United States are in gold. They have not participated in the big gains we've seen recently. Only a select number of investors are in these type of investments, and that can change. We're seeing a lot of talk. Of course, I mentioned in the last video, Morgan Stanley CFO talking about changing the 60-40 portfolio to a 60-20-20, which is absolutely impossible. So we continue to watch gold. Obviously, at this point, it's kind of traded back up. It's not back to the all-time high it reached, but it is slowly creeping up there. So we are watching that closely. What do you think gold prices are going to do? Are they going to continue to go up? Do you think they're going to crash? Put it in the comments below what you think is going to happen with gold prices. And of course, along with all the other assets, we're seeing big increases in value. The S&P 500 is up about 13% this year. That is a nice gain for the year. The Dow Jones is up 9%. That is a nice gain for the year. Of course, we're doing very, very well. The Copley Tactical Fund is up about 22% so far this year. And Alpine, which has continued to be a good performer, is up about 21% this year. So a lot of the investments that our clients in have really outperformed. Do not expect these kind of returns every year. We've selected some great investments this year. But all of these increases in asset prices are driving a bit of a bubble in valuations. Obviously, we've talked about this before. A lot of the valuations in the market, whether you look at earnings, you look at the market capitalization of these companies, they look expensive. But that does not mean the market's going to crash tomorrow. It can keep going up. It can become even more overvalued. What I've seen over the years of doing this for 25 years is the market goes up way more than you ever thought it would. And then once it goes down way more than you ever thought it would. And so this is the nature of markets. And so we can continue to participate on the upside, but we do want to make sure that we're taking some extra steps to be cautious with the different types of investments. So what can you do that you might be able to continue to participate in the upside of the market, continue to make good returns, but maybe take a little bit less risk? So one way to participate on the way up in the market and have some protection is to use our buffered index portfolios. These have been extremely popular and successful for our clients. One that we have available right now is a 2-year buffered index. It has an 18.2% cap. It's on the S&P 500. So if the stock market goes up anywhere from 0 to 18.2% over the next 2 years, you get the whole thing. If the market's up 12%, you get 12. If it's up 17%, you get 17. If the market is up 30%, you're only going to be up 18.2%. In exchange for giving up everything above 18.2, we're able to buy 2 insurance policies. It is a 20% dual directional policy, which means that in the event the market goes down, not only do you not lose money, you make the opposite return. So if the market's down 10%, you make 10%. If the market's down 18%, not only do you not lose, you make 18%, all the way down to negative 20. In the event the stock market is down more than 20%, you just get a 20% reimbursement. Now, we have another take on this that's very similar, a little bit different investment. We have a buffered index now available. Some people say, I want a higher cap than 18.2, and I want to have more insurance. Well, if we remove the dual directional feature, the inverse feature, we can get up to a 27.6% cap, and we can get a 30% insurance policy. Now, in order to get this big insurance policy at 30%, we did have to take what's called the lesser of the S&P 500 or the Dow. The way this works is, let's say, for example, this year the S&P 500 is up 13% and the Dow's up 9%. Well, you're only going to be up 9% with this particular type of index because you get the lesser of. But we can take a cap of up to 27.6. So in the event that one of them's up 30% and one of them's up 25%, you're going to be up 25% because that is within that 27.6. So it gives you an opportunity to make a little bit more. Now on the downside, it's got a great 30% protection. So if the stock market's down 15%, you don't lose. If the stock market's down 20, you don't lose. Stock market's down 25, you don't lose. If the stock market's down 35%, you get reimbursed 30, you're only down 5%. So it has a much bigger insurance policy, but it does not have the inverse. So if the market, say, was down 10% with the first one, you make 10%. With this one, the market's down 10, you just are even. You don't make anything, you don't lose anything. So these are two really good policies. One has that dual directional feature, smaller cap, less insurance. One does not have that feature, larger cap, more insurance. Both very good products. We were hoping to get a leveraged S&P 500 investment. We've been talking about this in the last few market updates, how we can beat the S&P 500. Well, in this case, we tried really hard. We could not get the pricing on this product. So we do not have one available right now. Unfortunately, we are going to be looking and trying really hard on the next offering to try to get one that is going to beat the S&P 500. We're hoping for one that's at least a 1.5 or 1.6 times leverage. So we'll announce that as soon as it's available. The current buffered index products today are available until December the 2nd. They do have to be funded and in by December the 2nd. So typically in that case, I'm going to tell people, get in before Thanksgiving if you want to do these, so we can get everything funded and in by the December 2nd deadline. And then after that, we'll be looking at new pricing, new offerings, what is available. We're going to be pushing for one that we can beat the S&P 500. We'll see if that happens, and we'll announce that along with the other ones that have the insurance, the buffered protection, which I think is really important with the current market, the way it's at, with very high valuations, potential bubble in AI. This is how you protect yourself. Of course, if you say, I just don't want any risk, I want guaranteed interest, I want to make sure that no matter what happens, I get a certain rate. We do still have some great interest rates today. Our 3-year MYGAs at 5.5%, 5.5%, very nice return. Our 5-year MYGAs at 5.7%. Very, very nice return. And so reach out to us if you just want guaranteed interest, and what you see is what you get. The companies could afford to probably pay you more than that. Say on the 5.5, they might be able to pay you 5.8 if they weren't paying us, but your 5.5 is what you see is what you get. So those are some great fixed returns for you available, and there's nothing wrong with getting that. At least you're beating what you can potentially get out of maybe the bank, and you got to keep up with inflation. So it's very important. If inflation's running at 3 or 4%, you got to have a higher return than that. Money sitting in the bank that's earning less than that is a guaranteed loser. You are losing money on that. So you want to make sure your money is working for you. At least get that safe fixed return. And if you want to try for a little bit more, buffered index is a great way to get those higher returns with some good protection. And of course, if you say, I just am a long-term investor, I want to make some returns. Hey, the Copley Tactical Fund, Alpine Capital, we're doing great this year. And I think that we're going to continue to work really hard to get some good performance out of those. And so thank you all for watching. I hope that was a good market update, and I hope to see you in our office very, very soon.